Hello everyone, welcome back to my channel. I am Nundumiso Njangase, and for those of you who are new to the channel, a warm welcome to you, and I do hope that you stay on and please subscribe and also hit the notification bell so that you get notified when there is new content out. Please note that my videos don't constitute as financial advice or legal advice for that matter. If you do require financial advice, please consult with a financial planner or a financial advisor who is registered with the Financial Sector Conduct Authority, or if you need legal advice, please just go to a lawyer, not this one though. So today's video is inspired by a book I was reading called The Psychology of Money. Actually, I was listening to it on Audible. I wasn't reading. I do read, but I wasn't reading it. I was just listening to it on Audible, and it was quite an interesting book. Please check it out, Psychology of Money. And the author was talking about, how bubbles form in one of the chapters. So, bubbles where maybe a company, the share, maybe let's say it's worth 1,000 rands. And then next thing, everybody's flocking to it. And then now, price it's now maybe 5,000 rands, but it's actually just aglingani because a lot of people are flocking and it's inflating the price. So it's a bubble, and then maybe a lot of traders are just pumping money into it, and then it reaches a certain price and then they sell. And then you guys bought, and then you just left high and dry because you're like, okay, I thought we were riding this train and we won't be here forever. And then no, people have left and you now lose money. So he's explaining, it's okay, how do bubbles form? And he's like, the reason behind bubbles forming, one of the reasons, because he says there's like a lot of reasons, but you can't pinpoint why. But the one that he thinks causes bubbles to form is that investors tend to take investment cues from other investors. So they basically look at what other people are doing and then do the same thing for themselves. And I thought, let me actually just, go and do a short video about this, because I feel like this is actually a trap. It's actually a trap that we fall into, especially as new investors. I think in South Africa, we really, not all of us, I mean, a few of us had access to the markets before, right? Because investing investing in the stock market in particular was very expensive. I in particular, in 2015, I actually was busy trying to invest in the stock market. I did my research and I found out that, for every transaction, I think you had to pay something like 150 rands. And then also, when you're buying, you pay 150 rands. When you're selling, you have to pay 150 rands. And I think you had to pay something like $50 a month to maintain the platform, right? And I was like, this is not gonna, make sense for me. If you are a new investor and you're just investing 500 rand in Genyanga, you don't really, it wasn't really easy for us. But with platforms like Easy Equities, they have made investing so easy for us, and you just jump in. And now I've seen, especially with Abantu Bagiti, I've seen so many of them now joining, but understand what's happening in the stock market. Why do people do what they do? It's still really tricky, right? And then we need to also understand that the stock market has been around for a long time, right? I think in the 1800s, right? Is it the 1800s? I think so, but 18 something. It was formed there, not necessarily in South Africa, but it's been around and people have been making money of it. Some people have lost a lot of money from it. So I really am concerned about, people jumping in without understanding. And another concern for me is, I've seen even here on YouTube where there's videos, people showing you, it's okay, this is what I bought and whatever. And I feel like that's so beautiful when people actually teach you, it's okay, this is what I bought and this is why I bought it, right? And they show you, it's okay, I did my research. And in my research, this is what, I found, and that's why I decided, let me buy the stock. But then the sad part is that people will just listen to what the person is saying, and then they come and apply it blindly into their lives. You need to know that, with investing, there's a lot of things to consider. And, the statement that says each to his own applies 100% in the stock market. You can't replicate what I'm doing because I'm Nondumiso Njangase. Ngina 32. Well, I'm turning 32. So you can't really, as a 21-year-old, do what I'm doing, or as a 45-year-old, do what I'm doing, right? I don't have kids. You probably might have kids. There's a lot of factors to consider. What are the goals for unondumiso specifically? And they might really, really differ from a 21-year-old or from a 45-year-old. So I just want to encourage people, number one, to have an investment strategy that is tailored to you, to say unondumiso njangase, who is this old, who has these goals, who wants these returns, and who is scared of risk or is not scared of risk. Unondumiso njangase specifically what works for her, because I might watch a YouTube video of this person buying a Purple Group, for example, and then I jump in and buy Purple Group as well, and then Purple Group later on I realize, why is it doing what it's doing? And it's because I didn't come back home to say, okay, does it align with my investment strategy, right? So you need to actually take this into account and ensure that as much as you can sort of look at whatever another person is doing and bring it home and change your investment strategy based on what you've seen, because we're always evolving, we're learning, but come back and change it once you've considered why you want to change it. And just don't change it just because you've seen someone doing something and you also want to do the same thing. You need to think about it, because we don't want a situation where people in future, now they've invested all their monies in the stock market, and then they're like, I know stock market is a scam. Stock market, because they didn't actually do the right thing. Guys go to school to study for like investments. They have degrees, they have masters, and sometimes stock market kunjalo. So it means you really, really need to take it seriously. You really need to. So you have to think about what you are trying to achieve, number one, because for example, when you're looking at what you're trying to achieve, look at the returns you're trying to achieve. Are you trying to achieve 5%, 10%, 15%? Are you trying to beat the markets, Because then whatever you pick after that will be influenced by how much return you said you wanted to achieve. You might not achieve it. You might be close, or you might top. You might actually you might exceed it, but you need to know, because you need to know if you've failed or if you've succeeded. Because I might be comfortable, I might say, okay, 15% is good enough for me, or 10% is good enough for me, right? And I'm happy with that. It's in my strategy to say I'm only trying to achieve 10% a year in the stock market, right? And then I see people making 70%, making 80%, and then I think I'm a failure because people are making more. But then if I've already written it down and I know this is what I'm trying to achieve, then I won't see me as a failure in my eyes. I won't be a failure because I've achieved maybe the 10% I wanted to achieve. It could have been nicer if it was 70, but if it's 10, I've achieved what I wanted to achieve. And then when you won't be now swayed by how other people are performing, right? And with obviously returns, the types of returns that you choose, the risk would be similar, right? The greater the risk, the greater the returns, or vice versa as well. So if you're willing to take a lot of risk, you could actually also gain a lot. But if you taking a small amount of risk, then you need to know that you're also going to have like a small amount of growth. And there's nothing wrong with not wanting extreme gains. That's all we want at the end of the day. We do want to make 100%, but we need to be realistic, right? Kuba ukuthi usumenze 100%, if that was your plan, well done. But be comfortable in saying, this is what I want, so that you are able to track whether you have succeeded or you've lost. And with the risk, that's very important, because for me in particular, I'm a long-term investor. So I know, Guti, this money that I'm putting here, it can sit here for 10 years. I'm okay with that. And if it's down 50% in the next few months, I'm okay with that. Right now, my portfolio is just I'm like, what's going on? But I'm chilled because number one, I know that I'm willing to take that risk. I'm willing, 30%, I'm okay with it. I sit, unless, I mean, there's a whole lot of, unless there's a scandal or like something blowing up, then you're like, okay, maybe then let me relook at this. But when everything is still similar or the same as you bought and you still have the same reasons and they haven't changed, there's no reason to panic, right? But based on my risk tolerance, mina ngiyazi ukuthi mayehlile, I'm okay. You might not be okay, masiyehle ngo-30%. You might panic and have a heart attack. So you must make sure that you know what's comfortable for you. And I mean, also what influences risk is that you will take 100,000 wako ufake in the stock market, right? And maybe you're willing to actually let it go down to even, let's say 30%, drops by 30%, and you are comfortable with that because you won't need that 100 rands, the 100,000 rands in the next few months or next few years or whatever. You are okay with that. But if you know that you have put 100,000 rands and it was money that maybe you're gonna go and deposit a house with, you're gonna panic when it actually drops. So you also need to put in money that you know that you are willing to actually risk, right? And know a level of risk. So your level of risk and the type of returns that you want to get will determine the type of company that you invest in. That's why I want to caution people against rushing and investing in what other people are investing in, because if your level of risk is low and you just go and invest because you investor people group, then you're gonna have a problem because you haven't checked whether you're willing to take the risk that Unondumiso is willing to take. So bring it home. Every time you see somebody buying something, bring it home and see if this type of company, is it aligned to what companies I'm trying to buy? Because you might want to be buying companies that maybe kokama dividends, right? If you that person who says, I want companies that pay dividends, or you can, have a mixture. It depends on what you want to do, really. Maybe you're also a person who says, okay, I want companies that, growth companies, for example, where we are born with, okay, right now, this share, maybe even intrinsic value, your share is, not your company or your share is not the same as what the share is worth. But the company would say they have brilliant plans for the future. I know that they're going to grow. Then you're like, okay, I can buy it for this much because maybe I know they're going to grow in the future. Right? Maybe you're a person who has that, philosophy as well. Or you're a person who wants to buy like value companies where, they're nice and stable. They'll give you like, stable growth and it's okay, I'm sort of kind of protected here, right? So then if you use this thing, you would see buying something and you go and buy it, then it might actually interfere with your strategy, which is like, okay, no, I'm only buying companies with dividends. You would go and bring a company that doesn't have dividends, that doesn't pay dividends. So you need to know what you are doing. Write it down. And I think writing it down is the perfect way, because then it's okay. The information out there saying, okay, this is a nice share. Let me also come and bring it to my strategy and see if it matches. If it does, good and well. If it doesn't, am I willing to adjust, and why am I willing to adjust? If it does not, sometimes you just let them be. Because at the end of the day, in the stock market, there will always be opportunities. So just because there's an opportunity now that everybody is taking, do not let that influence, your strategy. Unless there's really valid reasons why you want it. So you need to know that time when there is this thing, a hype about this share, okay, why do I need to bring it into my portfolio? And the money that I'm putting in, am I willing to lose it? And actually, am I trying to buy companies that I feel like are going to grow? Am I, what am I trying to achieve? Then you bring it home. Then I'm not going to buy this now, right? So please, make sure that you do have an investment strategy. Review it as and when you see these things, but don't just go into these things blindly, because we don't want people who are going to come now and say the stock market is a scam. And it's unfortunate because when you actually don't do research, when you don't read about these things and really educate yourself about it, you're definitely going to think it's a scam, because you were replicating what somebody else is doing, who had different goals than you, who wanted maybe to sell in 3 months, or and then you're going to be holding. Next thing, this thing plummets. So please, I know I am a broken record when it comes to these things, but I feel like really let's think about these things properly before we commit to them. And I mean, honestly, the stock market is not the only way to invest. You have other asset classes. You have cash, you have property, you have bonds. So look at all these other things and see in your strategy, okay, I want this much, wow, English. I want this much percentage of stocks. I want this much percentage of bonds. I want this much of cash, because you do need cash. Because another thing, Eshaya, ama investors, is not having cash. Not having something that when you need it, Safan will in the stock market and sell at a loss. So please make sure that you, in your investment portfolio, once you have chosen what's okay, maybe it's the stock market that I want to also include the stock market. Make sure that investment strategy yako uyayilandela, you review it, and you also don't let it get influenced by hypes, by bubbles, by people who are just influencing. So yeah, and yeah, guys, please consider these things. And I'm not trying to scold you. I just want you to succeed, and sometimes you do require a little bit of scolding. So yeah, anyway, happy investing. That's all I wanted to say today. And I hope everything goes well for you. And if you feel like, hey, you know what, but I don't know, I'm gonna be comfortable, that's all good and well as well. Maybe stick to the index funds. I heard a story in fact, in the book that I was reading, about this guy who invested in index funds, so in like ETFs, for example, for years, right? So he was earning salary nje. He wasn't like a guy who was like cool. He was just a modest guy earning a small salary, and he was taking a percentage of his salary every month. I figure in the stock market, but in an index fund, so in like an ETF, where maybe it's like a combination of a lot of stocks that they are trying to check, right? Tiwa, when this person passed away, he had millions, and they didn't even know, because he was living modestly and he wasn't like investing in the stock market like crazy. He just steady. So sometimes it's okay to be steady. And I mean, as and when you earn more money, as and when you grow, as and when you learn new things, then you adjust. But as you're starting out, guys, please make sure that you are very cautious in the stock market. All right. Have a very beautiful day and happy investing.